Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Rima as well as Mangalam. Guys, good morning.
Hi, good morning.
So, when I was told that you have to fill in for the 8 a.m. show today, the first thing I did was looked at Trump's Truth Social account, and then I looked at all the other things. Thankfully, today seems like there is not enough overnight development for us to worry about this morning. Yesterday, yes, we did see a recovery. The recovery was sold into, etc. One is hoping for some stability today. So that's...
you know what I do when I know that I have to do the 8 a.m. show at 5 o'clock in the morning? I wake up and see all the tech news. right? Because every single day there is so much development.
That I think you have to do whether you're doing the 8 a.m. show or not, largely because of the disruption that is underway right now.
Yeah, I'll tell you what, guys. 9 till around 3:30, markets will be in focus. And from 3:30 onwards, an eye on the cricket pitch. India is...
Match is at 7?
Is at 7, yeah. But we have West Indies as well as South Africa that play earlier, and we are hoping for a result. Either which ways, we need to focus on our game and knock out the Zimbabweans.
So you're wearing the blue shirt for India. I'm wearing the red one for West Indies. Hoping that if West Indies wins against South Africa and, you have India winning against Zimbabwe, then our, way to the finals or semi-finals is through.
So we'll talk a lot about the games later on, but for the time
being...
After 3:30.
For now, let's begin right at the top and run you through all the big cues to prep you up for today's trading session. Well, to begin with, back-to-back gains for Wall Street. The S&P 500 gaining 0.8%, the Nasdaq climbing 1.2%. The Dow also higher for the second straight session. It rose about 300 points, and it now needs about another 150 points to recover all of Monday's losses. Well, NVIDIA results in focus. They came out post-market hours, and the key takeaway is the AI demand is very much alive and kicking. Solid Q4 numbers and the Q1 revenue guidance was way ahead of estimates. To run you through some numbers, Q4 revenues went up 20% quarter-on-quarter, 73% on a year-on-year basis. The FY25 revenues up 65%, $215 billion. And to put that number in context, $215 billion of NVIDIA's revenues would compare with, say, a $54 billion for Intel, $23 billion for AMD. These are the peers of NVIDIA. But the big headline is that the Q1 FY26 guidance at $78 billion is just ahead of estimates. It's just that the stock immediately rose about 3% in after-hours trade, but finally cooled off. I guess there is something called the law of diminishing surprise, because NVIDIA quarter after quarter has been beating expectations, raising it, but this time the stock price reaction post numbers were muted. Salesforce also came out with the Q4 numbers, again a beat on revenues and EPS. But the good news for India is that the software stocks in the US largely continue to see that upward momentum. I think there was one statement from Jensen. He said, I think the markets got it all wrong on the idea that AI, including agents, will cannibalize or severely disrupt software firms. So he brushed aside those fears, and Salesforce, Palantir, Globant, all stock gains of about 3 to 5%, and even the Infosys and Wipro ADR up 2 to 3%. So hopefully, the momentum that we had in the IT stocks yesterday will continue. On commodities, gold and silver, no big moves overnight. Brent crude around $71 per barrel, and all eyes will be on the US-Iran meet in Geneva, as US envoys will meet an Iranian delegation for the third round of high-stakes talks today. Dollar index hovering around 97.5. For us, we'll pull up that GIFT Nifty, should come up for you on your screen. It's just that yesterday's price action seems to suggest that 25,650 is a resistance level. Until we conquer that, maybe the range stays. So yesterday we had a gap up opening. The Nifty raised to levels of 25,650, and then we had a dramatic 200-plus point reversal from the top. And if you look at the highs for the market over the last 4 trading sessions, in 3 of them, the markets have stalled around the 25,650 mark, suggesting that that is the immediate resistance for us to conquer. Well, the good news is that, it's hard to explain what led to that dramatic 200-point reversal from the top, but both the FIs and DIIs were buyers in the cash market. The DIIs net bought nearly 5,100 crore in the cash market. The FIs net bought 2,900 crore in the cash market. There were some block deals that we had Aditya Infotech, SpiceJet, so that could influence the DII buying. And what to watch today? Well, today is the sensex monthly expiry, and we also have the BankX expiry today.
Well, that's right, Rima. So an eye on that expiry as well, since it's a Thursday and you normally have that sensex weekly expiry that plays out. Well, the FIs, they appear to be back. We made this point yesterday as well. After many, many months, they have turned buyers, and the quantum of buying actually is the highest that we've seen in more than a year. So that's encouraging. So it appears, at least as of now, the FIs are back going by the flows, and the DI flows, well, that remains supportive. So institution net buy number is something you like. What do the FIs do on index futures? They went ahead, they lightened some positions on index futures, but they added more longs than shorts on stock futures. There's an arbitrage as well out there. But long addition is what we saw with them buying in the cash market. The problem is call writing. In yesterday's trading session, the Nifty actually ended up. But there was writing that you're seeing on a couple of strikes. 25,700 call, 25,650 call. And there was a good amount of open interest built up, but the premium didn't move up. In fact, there was writing being seen at both those two strikes. However, what's giving you hope is that 25,500 put continues to see a good amount of addition, telling you there is writing out there. And ballpark, if you look at it, the premium was around 150 rupees. And on the upside, the 25,700 call, premium was around 70 rupees. Let's just punch both these two premiums in and we'll get the near-term support as well as the resistance mark. The recent highs, that's the last week we saw, 25,771 ballpark, around 25,700, 25,770. That'll be the near level of resistance that we're looking at. So you'll want to get past this to believe that you're on your way to fresh all-time highs. On the downside, since you had, premium at around the 25,500 put, which was around that vicinity of around 150 rupees, the 200 DMA becomes your reference point that you're looking at on the downside. So that's the important mark. This is the very, very near-term range that we're looking at. The Nifty Bank, well, it was leading the way. In the last 7 trading sessions, it's been in this 1,000-point range. That comes up for you on the screen. So you'll want it to break out of this range and then give further direction, because that's been the leader. That's lost its way a little bit. You'll have to keep an eye out on the Nifty Bank because that's been the index to go to. And it appears like the tech index is showing some kind of signs of bottoming out with the kind of shorts that we've seen in the system. So we'll keep an eye out on that. A stock that we'll be focusing on, not just for today, but for the coming few trading sessions, is Sammaan Capital. Yesterday, volumes were massive. It's moved into the F&O ban as well. So Sammaan Capital, I think for the next few trading sessions, extremely crucial with regard to progress on the deal that they had done earlier. Have they got the regulator's green signal? I'll keep an eye out on that particular name.
All right, Nigel, thanks a lot for that. So those are a bunch of cues that we have to watch out for from both the globe as well as domestic local F&O cues. Prashant Baroda, who's the portfolio manager emerging markets at Allspring Global Investments, joins us now on the show. Prashant, good morning. With all that's taken place on NVIDIA and Salesforce overnight, we've seen some supply for the Indian markets at higher levels as well. What's your sense? Where do we go from here on the emerging market pack, India and the AI trade? Does that unravel further?
Well, I think the biggest question, NVIDIA actually had pretty good earnings, but the biggest question mark for investors is that the 700 odd billion of capex that their customers are doing, has that peaked out? And that is, even though with the good numbers, you see the stock isn't moving as much because some investors have concern over that. Now, if the AI trade kind of plateaus from here, I think it augurs well for markets like India, where you have, you'll see sort of mid-teens earnings without any of these AI kicker stories. So we'll see how the market shakes out. But yeah, the question in everyone's mind is the 700 billion capex, is this kind of the top?
That's true. And the other big question is how much bigger can NVIDIA get, right? It's already 7.5–8% weightage in the S&P 500, about 5–5.5% of MSCI. So just the sheer size, right? How much bigger? And I remember in 2023, Apple also hit this peak threshold of close to about 8 times of the S&P 500 weight. and it acted as a natural ceiling. There was forced selling which is to come in to rebalance your portfolio. So there's also that question, like how much bigger after hitting this near $5 trillion market capitalization can NVIDIA get in one's portfolio, even though the growth numbers are very strong. But Prashant, back to Indian IT. I remember in our last conversation, you said you're underweight Indian IT. And then you have companies growing at 65, 70%, like NVIDIA. You can buy that, or you can buy an Indian IT company, which is struggling to grow in low to mid single digits. But valuations are now getting fairly attractive compared to, relative historical context. Is it time to start looking at Indian IT companies, or it's still in a void for you?
I think the IT companies have to kind of prove themselves, and maybe towards towards the end of this year, on the next few quarters, if there are few IT companies that continue to grow at higher than sort of single digit rates, maybe there'll be some relief rally in some of these names. But overall, the question marks will still remain. The problem today in the market is that all the innovation is happening on the private side, and the public markets have to kind of answer. And I think those questions will, once you have an OpenAI IPO, will only be solved then. So till these companies remain private, I think there's always risk of new innovations kind of threatening the public side.
Hi, Prashant. Morning. Good to see you win. What about the flows to India? That seems to have turned around. It appears the foreign money is gradually coming back. And, most of the indicators, the high-frequency indicators on ground indicating the economy is getting into a better shape. You had mentioned earlier that Indian markets could be a surprise package in 2026. You expect us to outperform? Would India be top of the pecking order after the recent underperformance?
Yes, I think as this kind of AI trade kind of plateaus, I think people will look at kind of new opportunities, and India does kind of come in that frame. And when you look at some of these companies are still growing at a decent clip, and valuations also in some of these names is not too high after the underperformance over the last 2 years. So I think India will definitely come into the picture. And, what's happened over the last 2 years is as this CapEx binge has happened in US, initially NVIDIA took all the profits, and now kind of the memory names have taken a lot of the profit share. But I think as sort of CapEx growth year on year at least doesn't grow as high as it used to be, India comes into the picture there.
Just quickly run us through. Have you been buying anything in India? If yes, what?
Yeah,
and what?
we've been selectively adding to some financials in India, Hima, and I think selectively we've been looking at opportunities. And I think the great thing is over the next few quarters, we'll see sort of earnings come out of these names, and you'll see decent growth. So we think other investors will also appreciate that.
Okay, thank you very much for joining in. Moving on now, let's quickly run us viewers through the interactions that we've lined up on the show today, what you can expect. At 9 a.m., we have Elara Securities Bino to discuss the recent developments in weight loss drugs and the overall pharma sector. 9:20, Karthik Kumar of Axis Mutual Fund will be our market master for the day. 9:30, the management of Bandhan Bank will join in to discuss the company's road ahead for FY27. Following that, we'll chat with Barclays Private Bank's Julian Lafarge at 9:40. On markets and more, 9:50, we have HDFC Bank's Ramesh Lakshmi Narayanan on the recent AI trends, the key monitorables. And towards the end of the show, Lata will speak to Goldman Sachs' Kamakshi Trivedi on the rupee dollar index and rate. Stay tuned. Welcome back. It's time now for CNBC-TV18's list of top stocks for the day. Our entire research team joins in to prep you up for the stocks which should be on your radar. First up, Gaurav, it's over to you. IRFC, where the offer for sale is on. And why is Manappuram Finance on your radar?
Well, let's talk about IRFC. Yesterday we saw government actually launched its OFS to offload 2% stake, and they also had a green shoe option for additional 2% stake sale. Now, yesterday the issue was open for non-retail investors, but if you look at the subscription data, it was undersubscribed. A little less than 95% of the total portion was subscribed by the non-retail investors, and that is the reason why government has opted not for exercising that green shoe option of additional 2% stake. Remember, the price was set at 104 rupees and the issue will be open for retail investors. If you look at the price, the current market price is normally little above the 104 rupees that was set as a floor price. So we will be seeing how retail investors treat this issue, but for now they are not exercising that green shoe option for additional 2% stake. When we look at Manappuram Finance now, management, one of the team member from the management, Mr. Deepak Reddy, who is CEO, has actually informed the company that he will be requiring medical leave of absence from 25th of February, and this leave will extend for 90 to 120 days. He will be going overseas because of the medical care that he requires. Now, that may be seen as a little cautious for the company, given that the CEO will not be there for at least 90 to 120 days. So, that is something that we will be watching out for, and as a result, going with mild rate for Manappuram as well.
Got it. All right. Thanks a lot for that, Gaurav. Let's hop across to Hormuz. Hormuz is tracking Home First Finance and E2E Networks. Morning, Hormi.
Good morning, Nigel. And block deals are back just as earnings are over. And True Home First Finance is the next in the list today. True North and Ather Mauritius, both of them classified as promoter entities, are likely to be sellers here. Transaction of around about 850 crore, close to around about 6.8% of the total equity as well. Floor price is around 1185 rupees, around about it's a discount to which the stock had closed in yesterday's session. As of December, True North had a 7.5% stake in the company. Ather had 4.9%. The stock has done fairly well, even though it is down from its 52-week highs. So expect some supply to come in, so the stock will open in the red, but depending on the buyers may see some recovery. As for E2E Networks, well, it has launched a QIP this time around to raise funds, and the floor price is at a premium compared to the stock at which it had closed in yesterday's session, and it's the stock ended 5% higher yesterday. But the big question is, will L&T subscribe to this QIP as well and increase its stake? Currently holds around 19%. So expect some green here for E2E Networks, but red for Home First Finance.
All right, we take that point, Hormaz. Thanks a lot for that. A bunch of results post-earnings season. We have KSB, Sanofi India, Sanofi Consumer, all of them. What does the street make of those numbers? Vinny joins in for the same. Vinny.
Hi, morning. So firstly, let's talk about KSB Limited. Numbers, good numbers that have come in. Actually, a steady quarter is what we could call it. So revenues are up by around 8%. Good growth was led by their pump segment, which also saw a 9% growth. Profits of the company and 11% growth there. Margins have seen an improvement of around 300 basis points on a year-on-year basis. So good in terms of the operational performance as well. Steady quarter despite the impact coming in of 25 crores of labor code. So that is why a thumbs up for them. KSB could see some bit of a green there. Sanofi India, on the flip side, has seen a decline in terms of revenue, 18% decline in terms of revenue. Even the profits of the company have seen a sharp contraction, down 32%. And this is the third consecutive quarter that we're seeing the revenues seeing a decline. Margins are at the lowest levels since December 2023. They've come in at around 21.6% and have contracted around 130 basis point on a year-on-year basis. Lastly, Sanofi Consumers Healthcare, that has managed to see a good number, report a good number, 47% growth in revenue. Profits of the company seeing a good growth as well. And the company has also declared a 75 rupees dividend per equity share as well. Margins remained flattish largely on a year-on-year basis, 35.8 versus 36.5%. So that's something that we're expecting green here as well.
Okay, all right. Thanks a lot for that, Vinny. Let's go to Ria now. She's focusing on some other stocks that are in the news. Morning, Ria.
Well, good morning. Let's start off with Zydus Life first. The company is going to launch an innovative semaglutide injection in India on the date of the patent expiry. And remember, earlier, the DCGI had already provided its approval for the manufacturing and marketing of this semaglutide injection. And Zydus is going to have the exclusive rights to this. So keep an eye on Zydus on the back of this news flow. LT Foods will also be in focus. The US DOC has lowered the countervailing duty on soybean meal exports exports by an arm of the company to roughly 75.5% from the earlier rate of 340%, and this will potentially reduce the potential liability for the company by 163 crores. So that is a big positive for LT Foods. Aditya Infotech will also remain in focus today. Dixon Technologies has sold roughly 3.8% stake in the company for 661 crores. Motilal Oswal Mutual Fund and Kotak Mahindra Mutual Fund have bought stake worth roughly 180 crores each, and other buyers include Axis Mutual Fund, HDFC Life Insurance, as well as 361 Mutual Fund. The deal was done at a price of rupees 1,470 per share, which is a discount of roughly 6.5% to yesterday's closing price. And further, promoters have also sold roughly 2% stake in the company to meet MPS norms.
All right, take that point, Ria. Thanks a lot for that. So those were a bunch of stocks that our team is watching out for today. In fact, in case you missed it, let's tell you the ones with positive news flows. We have E2E Networks, KSP, Sanofi Consumer, Health, Zydus Life, LT Foods and Aditya Infotech, while stocks with negative news flow, IRFC, Manappuram Finance, Home First Finance and Sanofi India. With that, let's go across to Manisha Gupta for a quick roundup of all the action from the commodity market overnight. Manisha, no big moves seen on either side.
Oh, well, yes. I will start with crude as well because that is holding at a 6-month high. It's an important day today because you have the third round of negotiations between US and Iran. And while both the countries really seem to be getting stuck on the nuclear deal and Iran so much on the uranium enrichment. So it will be interesting to see on whether they break through or not. Otherwise, a limited potential strike is what is being talked about from the US president there. Having said that, the reason that you haven't seen the crude prices surge is because the US crude inventories have gained up by 16 million barrels in the previous week. This is the largest weekly gain in inventories since 2023. Apart from that, the data also suggests that Saudi Arabia exports of crude oil are the highest in 3 years. So you are looking at enough and more supplies and inventories in the global markets, keeping the crude oil prices in check. What also has seen further gain today is the metal prices. You have gold, which has gained up to a 4-week highs. Silver gained up 3% overnight. That one is trading at a 1-month highs as well. And because the Chinese are back into the market, there's a lot of buying in metals, keeping copper prices also quite supported today.
Thank you very much for that, Manisha. We will slip into a break on that note. On the other side, we'll connect with Dipan Mehta of Elixir Equities for some fundamental stock talk.
Welcome back. You're watching us here on Bazaar Morning Call on CNBC-TV18. This morning, the GIFT Nifty is indicating that the start could be about 50 points higher. The question is, where do we go from here? Largely because the Nifty has been in this 25,550 to 25,750 sort of range. So to that extent, moderation in movements would be something that the street would be eyeing today. But speaking at the EY Entrepreneur event yesterday, Commerce Minister Piyush Goyal affirms faith in artificial intelligence and says that it will aid in better paying jobs as against taking jobs away. Let's listen in.
Some people are worried about the impact of AI on jobs in the Indian economy. I, for one, am not at all worried. I can clearly see before my eyes how the nature of job may certainly change. Salary levels may also go up, which is good for the economy. But we are going to need more and more talent as India uses artificial intelligence for its own growth story, providing services to the rest of the world, expanding our exports and services.
AI is for real and artificial intelligence will change how we live. That's the word coming in from veteran banker and former Kotak Mahindra chief Uday Kotak. Here's a slice of that conversation he had with Shireen Bhan from the sidelines of the EY Entrepreneur of the Year Awards.
What you make of this AI trade or the AI reverse trade that's impacting the Indian stock markets? Do you believe it's overdone? Do you believe the markets have overplayed the fears at this point in time? Or do you believe the worst is yet to come?
I think AI is for real. We can debate on the time and the speed of change and disruption. And that's where the debate is. But I want to turn this subject a little further is we talk about AI. It will change. Artificial intelligence will change how we live. But we're going to come to a stage where what is going to be even more important is what I call as wisdom. There is, as so far, no concept of AW, which is artificial wisdom. Therefore, human beings finally will have a role because wisdom will remain HW, even as AI takes more and more of our lives. We collectively, and that is Indian business and Indian policy together, have to take the challenge more than anything else that this time we will not allow certain companies and countries, like history, to colonize the world. We must make sure India is able to avoid colonization because of dominance coming through huge investments made by, frankly, two superpowers, which is US and China.
Well, and JSW Steel's MD Sarjan Jindal tells CNBC TV18 Shireen Ban that India will have to spend more on R&D and also emphasizes on the need for collaboration with China. Let's listen in to his comments and also the timeline he shares for the first JSW MG motor car in India.
We as Indian industry, we are not spending enough money on R&D. That's very clear. I told you just outside the same point. That because we are living quarter se quarter tak, that point is also correct.
Is that really the fear holding you back?
Sorry?
Is that really the fear that's holding everybody back?
Not really, not quarter se quarter tak, but we are not making enough money to invest in R&D. The industry, I'm talking generally for most of the industry, we are not making enough money. We have to learn from China because, my belief is that China is a country which is as large as India, given the population very similar to India. If you look at their bullet train program, we are, for the last 10, 12 years, we are building the bullet train, which is right in front of my office. I think we are still 4 or 5 years away from that first time that bullet train will move. And it happens to be Prime Minister's pet program, the bullet train, right? So it's a very high-profile program, but still we can't execute that program. And you go to China, you see like thousands and thousands of kilometers of bullet train running across cities. So we have to learn from a country like China, which is building the economy at a fraction of the cost of let's say, us. Because we are taking technology from smaller countries and more expensive countries. We have to learn from China. Now, how can we collaborate with China? That's a question which is not for me to decide. It's the government has to decide. MG is already on road.
No, your car.
JSW Motors, hopefully before Diwali.
Before Diwali, we'll actually see a JSW car on the Indian roads.
Wow, interesting. By Diwali, we'll be seeing a JSW car on Indian roads. Interesting. Deepan Mehta, Director Elixir, joins us on the show. Hi, Deepan. Good morning. You're eyeing a new car? You have an option later this year?
Yeah, well, certainly you could look at it because all these modern cars are quite phenomenal, not only in terms of design, but also in terms of infotainment. And from an investor's perspective, I think, these companies engaged in infotainment, premiumization, they are the ones who have a great future because people are changing their cars far more frequently than before. And now everybody's going for the, all the premium, the top end levels because the differential in the EMI is hardly anything. So, yes, I think it's great news for the auto industry and certainly very positive for certain auto ancillary companies.
So what does that mean for the other listed companies in the auto space? Do you think they'll be able to compete?
See, I think the initial, the new players who have come, be it BYD or MG, they are all still quite small. And the market also is expanding. At the same time, I think the per unit realization also is going up. Some of the Indian companies, Maruti especially, is now looking at export markets, and that's a good growth driver. So while the costs come down in India, I think certainly exports also will open up, and JSW also will look at exports, I'm sure, when the time is appropriate. So let's see how it plays out. But for the time being, I think auto industry volumes are looking very decent. And I think one should remain invested in them, although they are now reaching that fair value stage. But nonetheless, I think there's good earnings momentum behind them.
All right, Dipan, Varuna just mentioned over here that, Dad, I'm looking for a Diwali gift, so make sure. Just kidding, Dipan. All right, Dipan, let's talk about the tech space. You got plenty of news overnight. Salesforce came out with its numbers. They look better. The stock was lower because of the guidance. NVIDIA, very good numbers. The only question is, can they grow at this sort of a pace? And, the ones that are giving them business, can they sustain that sort of capex? What's your view on our tech space? Because now the argument that things are gradually basing out is getting a little bit louder. And there's a little bit more confidence that's coming in there. Otherwise, it was sell, sell, sell. Are you giving it a relook? Any of the services companies? Or if in fact you find some comfort in product names?
Nigel, this whole tech thing is pouring out of my ears. Like, there's just so much noise, and so much of uncertainty. We just don't know what's going to happen. I mean, you got pro AI companies, enthusiasts saying that IT companies will be finished, because the IT companies saying that, you cannot just apply AI straight away. You need us. We are the middlemen. We are the ones who will actually implement it. The truth is somewhere in between. But my sense is that the time to sell IT is gone because they've corrected so much. These things take very long to play out as well. Somewhere, I think better earnings, some positive news may take these stocks higher. And then we need to clearly watch this entire group very, very closely to understand who's really benefiting and who's actually getting eaten up by AI. I don't think that, you can paint all the IT services companies with the same brush when it comes to their challenges related to AI. Some companies will benefit using it internally or projects or whatever. Others will lose out. I don't know which it is, but I'm watching it very closely. And right now, I think it's just a wait and watch for us for the entire segment. No doubt, it's a large part of our portfolio, especially companies like Tata Elxsi, which we've been invested for last 10, 15 years or so. I don't remember also. And we are seeing steep corrections over there. So as I said, I think we are keeping it on the watch, and let's see how this plays out. But there's just too much noise as well, and that does divert you from some of the other maybe investment themes which may be there in the stock market.
No, that's understandable, Dipan. The kind of noise that there is and the kind of divergence of opinion. But which sector would you then see as relatively noise-free, available at better valuations, and maybe having enough of a play both in India and outside of India? Is there any place where you can park your money for, say, the next 2 to 3 years?
Mangalam, 2 to 3 years now is getting a bit longer time frame. But I think pharma companies broadly, I think, is something we're looking at getting overweight. They benefit from rupee depreciation. Now, additional tariffs or other fresh tariffs on pharma, that seems more and more remote. Valuations are reasonable. There's a huge opportunity coming up in the GLP space for these companies. Domestic market is a good, steady revenue and growth for the pharma industry. And they are gradually expanding into a lot of other markets, which are also coming out to be very, very profitable. So that is one sector one could look at, being like a nice quiet performer, and maybe seem to be entering into a decent growth phase as well. The same is true for specialty chemicals. If you see this earnings season across the board, right from Aarti, SRF, Naveen Flooring, so many companies, Privy. If you go company by company also, a lot of the companies reported very good numbers. Base effect has benefited them. Up to 2023, the entire specialty chemicals industry was doing exceptionally well. Then we had a cyclical downswing, and I think now we are on the upswing. They benefit from rupee depreciation, and again, these tariff things certainly benefits them. And I don't think China Plus One is completely dead. So that second segment, which I think one should look at very, very positively. And then, of course, there are the usual ones, auto ancillary, as I spoke in the beginning of the show, and NBFCs are something which we are quite positive about.
Dipan, more questions. Request you to stay on. Need to slip into a very short break. We'll come back and also run you through some of the big volume buzzers that we had yesterday and a few technical trading ideas with Sudarshan Sukhani and Mitesh Thakkar.
Welcome back and hope you're having a good morning. Well, Hormuz is back with us to tell us about all the big movers in trade yesterday and some of them that were backed by good delivery. Hormuz, take it away.
Nigel, you know, the solar companies were the ones that were in the spotlight. So we spoke about Vari during closing yesterday. Let's talk about the other one, Premier Energies. That was down 6%. And this was even after the company had already clarified that there were no exports that they had. It snapped a 3-day winning streak yesterday. It was the biggest single-day fall in over a month. And the Wednesday's volumes were the highest since September of 2024. So the stock fell on significant volumes as well. Over 1 crore shares were traded for Premier Energies. The 20-day average is less than 17 lakh shares. And the 670 put option for the March series was among the most traded options in the FNO side in yesterday's trading session. And however, despite more than 1 crore shares being traded, only 14% of those were marked for delivery. So only 17 lakh shares were marked for delivery. It's almost 3x of its 20-day average, which is close to 5 lakh shares. And in an already underperforming sector, the stock fell yesterday, still down close to 40% from its 52-week highs, which is well over 1150 rupees. What started to do well again is Laurus Labs, and it was the second straight day of gains yesterday. The volumes in yesterday's session were more than 50% higher in comparison to what we had seen on Tuesday, and they were also the second highest in the month of February as a whole. 21 lakh shares were traded yesterday, 20-day average of 14 lakh shares, and close to 40% of those shares were marked for delivery, which is around 8 lakh shares. The 20-day average here is around 6 lakh shares, and the stock is back near its record high levels, which is at 1140. And lastly, Graphite India, that was one stock that did well in the broader markets yesterday. The biggest single day gain a month. The gains have come in 7 out of the last 10 trading sessions. Wednesday's volumes were the highest so far in 2026. So it was the highest since then. 51 lakh shares were traded, 20-day average of 15 lakh shares. Only 22% of those were marked for delivery, which is around 11.5 lakh shares compared to a 20-day average of 4.5 lakh shares. And in a weak, volatile market like that, the stock ended at a 52-week high yesterday.
All right, Hormaz, thanks a lot for that. So those are a bunch of stocks which were buzzing around in yesterday's trading session, some backed by delivery as well. But this morning, what are the brokerages saying? What are the top calls? Sudarshan's passed through all those notes. Sudarshan, what stands out?
So first one is Poonawalla Finance. UBS has come out with a note initiating buy call up with a target price of 640 rupees per share. It's saying that strong management and promoter-driven AAA ratings are going to be key positives for the company, and LAP, that is loan against property and gold loans, will be the anchor products. And it believes that ROE is going to reach 2% by FY28, and that will be supported by margins and the cost. And at current valuations, stock is not fully factoring potential growth trajectory and ROE expansion that we might see going forward. Next one is IDFC First Bank. It has seen a 4th downgrade since the disclosure of the fraud in Chandigarh branch of worth rupees 590 crore. Today, BofA Securities has downgraded the stock to neutral, and target has been cut to rupees 75 from the earlier target of 95 rupees per share. It says fraud will disrupt deposit growth, cost of funds and loan growth. Also, it will increase the OPEX going forward and has cut FY27 EPS estimates by 13%. It expects re-rating to be delayed till full clarity emerges related to the fraud that company had announced. And last, and once again, it's Ola Electric. The other day, Rima was asking which is the brokerage firm that is the highest target price of 55 rupees. That brokerage firm too has downgraded the stock to neutral, and that is Goldman Sachs, and target price has been cut to 26 rupees from the earlier target price of 52 rupees per share. Also, it has cut FY26-28 revenue estimates. Now it's factoring in mid-single digit market share in FY30 and beyond versus low teens earlier, and it believes that cash burn at company will necessitate a fundraise in next 12 to 18 months.
Thank you very much for that. So, sir, now finally, is there anyone who's bullish on Ola Electric?
No one, no one.
All sells? All sells are neutral?
Yeah, yeah.
I am bullish on Sud.
All right, let's get in Dipan Mehta, Director of Elixir Equities. I guess, Dipan, no point asking you on Ola Electric, right? Wasted question?
No, I think that the entire category is not doing well also. We heard that statement from Rajiv Bajaj also about the subsidy. So I think entire segment within the auto industry is being challenged, and Ola being kind of a single product company is being affected. But nonetheless, I think, to play the EVs is better to the traditional companies. So, and the time to sell Ola Electric is gone. So you just remain invested. It's like an option. If it is able to turn around its operations and grow its market share, excite the customers when it comes to the products, then certainly it can rally from here. But otherwise, I think it's going to become a bit of a situation for the industry.
Dipan, by any chance, do you track E2E networks? Because this is a GPU play. I remember NVIDIA had partnered with E2E, and the stock shot to fame when L&T acquired stake in the company, and that re-rated E2E networks, brought it back in the spotlight. Now they're looking to do that QIP, 1,000 crore of a fundraise. Have you all been analyzing this company?
Oh yes, we've been analyzing it continuously and always thought of buying it, but very, very expensive. And what is happening is that in India, if you want to have a direct AI play, there are only two companies. There's E2E and there's NetWeb, which makes the servers. And E2E especially, I think, there's a degree of volatility in their earnings, but the company is growing very fast. So top line may keep on going up, but there's a huge depreciation charge as well. So that creates a bit of a confusion in terms of valuation, whether it is a non-cash, should we, give a higher multiple to the post-tax profits, or, we value it on a cash basis. So there are certain issues over there. But by and large, I think it's a great company, right place at the right time. But as I said, very, very expensive. It may still rally from here as well, but there's always an execution risk.
So it's fallen 35% from its 52-week high. It's lower than the price at which L&T acquired stake. But you're saying it's still expensive.
See, we tend to value it on traditional parameters, and end of the day, right now the growth is explosive, but these things tend to get captured in the stock price. And it's still loss-making, end of the day, last quarter also was a loss, although it was a cash profit. And as it expands so rapidly, the depreciation cost will go up, return ratios will diminish. And deploying also is not, it doesn't just happen once you install it, it's a process. So it's a company which is like amongst the top in our watch list, but we wait for the right opportunity to enter. And there could also be emerging competition from it, as we build out more data centers and more companies come to offer infrastructure for AI.
Dipan, just before we let you go, InfoEdge, do you have a word on that? Do you have any view on that? Largely because, one, it's down about 30-35% from its highs, very close to its 52-week low. And now as we speak, the cushion that InfoEdge has is the stake that it has in Eternal. Eternal's stake of about 13% accounts for nearly 50% of InfoEdge's current market cap, rendering nearly the entire business, which is available at half. Do you think there is a case for one to look at InfoEdge at these valuations, given the stock is lower and the kind of stake that it holds in Eternal?
No, first, disclosure, we've been investors in InfoEdge for several years, really for a long period of time. And now I feel that perhaps I'm reaching a level where I think I should exit the company. Because, of course, the whole Eternal holding, and they have a stake in Policy Bazaar as well. And that has got valued into the stock price for one. And that cannot be a reason to remain invested in InfoEdge. But what is really bothering me is the growth rate in the recruitment business is just about 10-12% or thereabout. And they continue to make losses in the real estate portal of theirs. I think it's 99 acres. And there's no, they keep trying to turn it around, but even despite such great trends in the real estate industry, that has not done well. And there are also other businesses which have not scaled up. The only wild card here is that they have made investments in 15-20 startups. If any of them turn out to be like a Eternal or a Policy Bazaar, then the stock will get re-rated significantly. And the management have been very savvy when it comes to identifying promoters, in the early stage. So that's a bit of a confusion in my mind. But I think that maybe a time has come to exit out of InfoEdge for the time being.
Exit InfoEdge. Two companies, Dipan, if you have a view. Urban Company, which is now very close to its issue price, and stock is corrected. I think the high was close to about 200 rupees. Stock is down to 107. And the other one is Meesho. It's holding up above the issue price comfortably. But again, it's fallen 30-40% from peak levels. Are these stocks attractive to buy after the correction?
Rima, these are very difficult companies from an investor's perspective. And, if you're looking for companies which will really bolster your portfolio in the 2030s, then it has to be companies like Meesho, or for that matter, some of these new age digital companies. Could be Eternal, could be Urban Company, and a lot of listings also are expected to be Pine Laboratories. So the way I try and look at it is that if the business model is different, if it is scalable, basically if it's a platform, then you buy a small portion of the portfolio, you can invest in it. Look at it like an option. If it works out for you, these companies can grow. In a 10-year period, they can give multi-bagger type of returns. If not, I think, they just flounder and you may exit at some point of time. But whether it's Meesho or whether it's Urban Company, their business model is quite unique and they will scale up eventually. I mean, look at the way some of the other businesses, like say Grow, for example, was making losses for several years and then an inflection point came and it went into profitability. Same with Car Trade also, new digital business, losses for several quarters, then one inflection point came and it, started making solid profits. So these companies, their revenues are growing at anywhere from 30% to 50%. And expenses are growing at 50-20%. So let us see when they reach that particular point and then how much profit they make. But for the record, both these companies you named just now, Urban Company as well as Meesho, I think they are quite positive in it. And just because they have corrected so much, I don't think that that kind of takes away the long-term investment model for these companies.
All right, take that point. Thank you so much for joining in, Deepan. We take a short break. On the other side, we have the pre-opening. Obviously, with us will be Elara Securities Bino to discuss recent developments in the weight loss drugs, the pharmaceutical space. We'll also connect with Sudarshan Sukhani and Mitesh for some quick technical trades. Welcome back. This is Open Exchange. You're watching us live here from the CNBC-TV18 Motilal Oswal studio. 17 minutes to go for the market opening. A few minutes for market pre-open as well. Perfect time to bring in Sudarshan Sukhani as well as Mitesh Thakkar. Thanks a lot, gentlemen, for joining in. Good morning. Seems like the Nifty is in a bit of a range. And what's interesting is that Sudarshan is wearing a red tie and Mitesh is wearing a green one. Let's see which way the market goes. Is it consolidating? Let's go with Mitesh first. Good morning, Mitesh.
Good morning, Mehul. The market, I've been saying that it's losing the directional bias. Most of the volatility indicators are turning flat. The trend indicators are, sideways. So I think this range of 25,400, 380, 350 on the downside to about 25,800, I think will remain for another few days to come by. And we might be in a market which is contracting in this range and trading should be more stock specific.
Sudarshan, your call?
Well, it's about the tie or it's about the Nifty?
The Nifty.
Is it connected?
All right. Well, the color was wrong then. I think we are up for a trend day on the upside today. Yesterday, the Nifty consolidated after that big decline day before. Now, that consolidation is good news because the lows were not broken. We had a sharp correction and we stopped there. Then we have very conducive world markets today. And we are also opening a little bit higher, which is good enough. So keep a tight stop, say somewhere around 25,400 and look to go long. Remember, today's sensex expiry and we would actually have a trend day on the upside. So I would be fairly upbeat for the day.
Okay, got that. Upbeat for the day, no relation with the tie. My outfit, there is a relation, but that is post 3:30 p.m. cheering for the men in blue. Let's get stock specific then, gentlemen. Mitesh, you go first. What are the stocks on your radar?
So for me, I think I'll go with more of buys and one sell. On the buying side is Lupin. Pharma did very well yesterday in a market which is sideways. Lupin is a buy with a stop at 2269 for targets of 2340. I have another pharma named as Aurobindo Pharma on the list. Keep a stop below 1194. Look for targets of 1245, 1250. Then a buy on ICICI Pru with a stop at 657 for targets of 690. And one sell call, that's Patanjali Foods. Keep a stop at 526.5. Look for a target of around 500.
Sudarshan, your stock calls, all green today? All buys?
No, it's a mix because the Nifty is a buy anyway. So ABB is a buy with a stop under 6,035. DBFAB is a buy with a stop under 6,260. I have two shorts just as a small hedge. Lodha is a sell with a stop above 1,035. And Ambuja Cement is a sell with a stop above 520. But if you get signs of a trend in the beginning of the day, you can avoid the shorts.
Okay, all right. Sudarshan, I wanted to ask you, since you're talking about a trend day, what about Reliance Industries? Yesterday we did see some kind of weakness, and that actually has been like an index by itself, holding one end up, giving the Nifty Bank company as tech was crumbling. Your view on the big boy?
Well, you're right. It was weak, and I don't think it's a buying opportunity today. If at all a rally comes, it will be by the banks and IT.
Okay, banks and IT. What about some of these new age companies? Eternal for one, it's down about 7% this week so far. It saw postage numbers, some selling. Then thereafter there was some recovery. Do you have a call on that one?
You're asking me?
Yes,
I'm very downbeat, so we'll just keep it there.
Okay. And Mitesh, your call on any of these new age companies? Eternal, is there a chart check there?
Yeah, I think, the stock has gone into a good action, from levels of around 305, 310 zone. And that correction still doesn't seem to be over. Last time we had the stock correct from 360, 365 all-time highs. It went to as low as about 258, and now it's sitting below that. So the earlier low has been taken out. It penciled in one target of 246, which is nearly achieved. But I think in a worst-case scenario, the stock can even head towards 233 to about 230 on the downside.
Videsh, IT yesterday reversed from important levels, support levels, and it managed to hold on to the green line even by the close of trade despite the profit booking overall. And this morning also software companies in the US were higher. Infosys, Wipro, ADR up 2 to 3%. Do you think the momentum in IT will continue? And where is resistance now?
I'd be skeptical. I think, IT is extremely oversold. The Nifty IT made a high of around 40,300 and then declined to about as low as about 30,000, in fact, below 30,000. So I think we may get a bounce back, and that is what it looks like. So around 32,400 to about 33,000, I expect supply could re-emerge, and therefore this bounce back would only be kind of a relief rally and not a stronger reversal. As of now, it doesn't look like to me that.
All right, doesn't look like that for you. And what about some of these solar names that saw a sharp sell-off yesterday? Do you have any call on them? Anyone that chartically looks interesting? There was Wari, which was down near double digits. We had Premier Energies, the management joined us, Vikram Solar as well.
So I think that was very clearly, outcome of the news flow which happened from the US side, and all these stocks, they were not into a big uptrend. They had actually declined and had gone sideways, and I think that movement will continue. So Premier Energy managed to, kind of hold on to its earlier lows of 680, and while intraday dipped below that, I think managed to hold on to that level. But again, I think this is just doing a range of about 680 to about 795 to about 800.
All right. Thanks a lot. Hang there, gentlemen. We'll come back to you shortly as well for the 9-10 calls, as well as calls post the market opening. But we're also tracking the weight loss drug market as it's heating up. Global pharmaceutical company Novo Nordisk has taken a sharp price cut of its weight loss drug Wegovy and Ozempic in the US. Bino joins in. Bino obviously is the head of research at Elara. Bino, the sharp price cut that took place, it's caused a bit of a flutter and fear in some of these Indian companies which were expected to sell at sharper discounts. Now you have Novo Nordisk itself selling it at a 50% lower price. Does that cause you to tweak some of your updates that you have or estimates that you have on names like Dr. Reddy's?
Hi, good morning. So these price cuts we are talking about on semaglutide by Novo Nordisk has happened in the US market. To begin with, we are not looking at any of the generic players selling semaglutide in the US market at least until late 2031. So it is beyond our horizon of projections, and I don't think any of significant semaglutide sales from the US market is priced into any of the Indian stocks. Further, the pricing of pharmaceutical products in the US is pretty complex. So even if they took a big sounding 50% price cut on the list price, that may not necessarily mean that the effective real price in the market falls by that much. It could fall, but it may not be falling by 50%. Considering all this, the news of price cuts, discounts in the US may not be very relevant to the Indian generic pharma companies. But we also need to keep in mind that Novo Nordisk is actually adjusting its prices continuously in all markets. In India also, there is possibility of some price adjustments that they could do as the product goes off patent next month. We will need to watch for that.
Okay, got that. Hi, Bino. Good to see you in, Bino. From a market perspective, people were fretting about this rupee depreciating. It went all the way to around 92 and then it's pulled back a little bit. You're building in that this could be actually a tailwind for some of your pharma companies. Explain that to us and who gains the most?
The Indian pharma companies are in general net exporters, especially the larger pharma companies, which have a significant part of their revenues coming from foreign geographies. All of them are going to benefit significantly from the sharply depreciated rupee. And this time round, the rupee's depreciation has just not been against the US dollar or the euro, but also even against other emerging market currencies. So this will result in significant additional growth in INR revenue as well as margins for Indian companies. I believe all the export-oriented pharma companies will benefit. All the large ones like Sun Pharma, Dr. Reddy's, Zydus Life Sciences, etc. And even the smaller ones like Ajanta Pharma, Gland Pharma, etc., which have all significant export revenues.
Right. From an Indian pharmaceutical company which is not impacted as much by any of these US FDA sort of issues, etc., the API plays, which one offers the best bet right now?
There are several companies or several stocks that are looking attractive at these levels. As I said, overall, the sector looks good after a year and a half, 2 years of correction in stock prices. Valuation have come off, look much more attractive. My top picks among the large ones would be Zydus Life, Sun Pharma, and Aurobindo. And among the smaller one, I like Gland Pharma and Ajanta Pharma.
And from the diagnostic companies, there has been a bit of a correction out there, but you're pretty bullish, I think, on the larger name, Dr. Lal's, if I'm not mistaken. That's a stock you like?
Yeah, the diagnostics companies in general have seen a significant valuation correction in the last few months. The valuations had run up quite a bit, but that has now corrected. The valuations for the entire sector has come down to historic average levels, and I find the stocks in general attractive at these levels. Being the leader and being one of the best-run companies in the sector, I do like Dr. Lal's, and that would be my top pick.
Right, stop one step away from the diagnostics of the hospital space. What are your thoughts there? Because, at one point these stocks were flying and now it's declined, consolidated, maybe overvaluation. Where do you believe we are on the entire spectrum when it comes to hospitals?
In hospitals, we saw a long 4 or 5 year extremely strong performance on the back of increased demand, penetration of health insurance, etc. post the COVID. That has softened a little bit with that strong growth, era of strong growth. Investor expectations had also run up a bit ahead of what is actually deliverable. Some of that has corrected in the recent times with the stocks correcting, earnings downgrades happening and multiples correcting. I'm still on a wait and watch mode whether all that correction that needed to happen is behind us or not. Probably the next 1 or 2 quarters of earnings for these companies will show. But obviously the large overvaluation that was there in the sector has corrected. Possibly it's getting more attractive.
Okay, so you're saying hospitals are getting more attractive. You'll watch for signs of bottoming out. What would be those bottoming out signs according to you?
The key would be to watch the very high expectations that are built into consensus numbers coming off. As new beds get added, the revenue growth does come from the new beds, but at the same time, new bets is a drag on your margins. The current street expectations and valuations does not fully build in those drags. In 1 or 2 quarters, as the companies report, I see some drag on the margins, which will drive down the forward estimates as well. I will wait for that process to be complete before I call it the bottom.
Binu, thank you very much for joining in. 9-10 calls. Let's get our technical experts in once again. Sudarshan, yours?
Buy ABB with a stop under 6,035.
ABB, buy. Nitesh?
I'll go with a buy on Aurobindo Pharma.
Aurobindo Pharma. All right. Moving on now, let's put the spotlight once again on solar companies. They were under pressure yesterday. This follows the US 126% countervailing duty on solar imports from India. Basically, imports of what's produced in India to the US. Vinny joins in to tell us how brokerages are reacting to this. Vinny, yesterday we chatted with the management and they seem to suggest limited impact, but stocks were still weak in trade. Now what are brokerages saying?
So brokerages also have a similar view. They are also highlighting that these companies do not have much of an impact coming in of this 126% duty. Why? Like we mentioned yesterday, that given that these solar modules which are exported to US require Indian-made cells. If they're not Indian-made cells, then they do not charge them this 126% duty that comes in. If it's Indian-made cells and it's exported, then that 176% duty comes in. Now, Nomura is also saying that, specifically for Waaree Energies, the management has also, they're highlighting that the management sees limited impact of this. They said that there is a pass-through clause with Waaree Energy also has. So most of the contracts, there would be a pass-through if there is an impact that actually comes in. And they don't see any impact coming in on margins, even if they have to pay this in terms of 126%. On the back of this, they continue to maintain their buy rating on Waaree Energies, target price of 2,709 rupees. Premier Energies, they continue to maintain their neutral rating, target price of 729 rupees per share. Motilal Oswal also is saying that, Premier Energies obviously has limited exposure to this. Waaree Energies, they clarified that they do not have much exposure to this as well. So they continue to maintain the buy rating for Waaree Energies as well as Premier Energies. Premier Energies target price is 1,000 rupees. Waaree Energies target price is 3,514 rupees per share. Nuvama lastly is also highlighting that, Waaree Energies, specific notice on Waaree Energies, they're saying that Waaree Energies over a period of time has started diversifying into other modules as well. They're focusing and they've signed a big 15-year deal on EASS deal as well, which is for some electrolyzers in Uttar Pradesh. Then they have also invested around $30 million for some other products in the United States as well, which will be manufactured in the Oman facility for them. So that 30 million investment they're making in Oman, that is also something that they're diversifying further into, and they don't see impact of this coming in for Waaree Energies. So buy rating and 3,867 is the target.
Thank you very much for that. Gaurav, IRFC?
Well, for IRFC, yesterday we saw OFS was announced, where government was going to offload 2% stake with additional green shoe option of 2%. Yesterday, the issue was open for non-retail investors, but if you look at the subscription data, it was undersubscribed. A little over 1.2 crores shares were undersubscribed, and that is the reason why government has opted not to go for that green shoe option. Now, today, the issue will be open for retail investors, but remember, the floor price was set at 104 rupees, and the stock price is also near that level at 104 rupees and at its 52-week low level. So definitely, we will be watching out on these stocks. Remember, there is another announcement as well. The company has got around 400 million USD worth of loans from SMBC, Sumitomo Mitsui Banking Corporation, and MUFG Bank. So that is also something which will keep the stock on our radar today.
Thank you very much for that. Awaiting the opening. Before that, a quick check on Asia. And it's super strong still for the companies related to the AI trade. So Kospi is one, where you've got an SK Hynix doing very well. I think Samsung Electronics, which is also a partner of NVIDIA. So Kospi is up 2.5%, but Hang Seng is retreating a bit. The first trade on the Nifty will come. The bell has rung, and we've opened up in the green. The Nifty is opened at 25,556, a gain of about 0.2%. So it's a modestly positive start. Up 50 points on the Nifty. The Sensex has opened up with a gain of 180 points, in line with what the GIFT Nifty was suggesting. Mid-cap index moves in step with the frontliners. The advanced decline ratio is positive. So it's a positive start, not a runaway rally. The resistance level we're watching is about 25,650. And if you pull up the heat map, I think once again we will find the IT stocks right on top. The top 4 gainers appear to be IT names. So the Nifty IT index was higher yesterday by 1.5%, and there seems to be some follow-through buying. The buy seems to be more on the positive side. On the way down, outside of IT, Eternal is the stock in the Nifty which has seen the most battering in this month, down 8-9%. And even today, it's the top Nifty loser now.
Well, that's right, Rima. I think, the NVIDIA CEO on software saying that the market's got it wrong. Nobody's going to service better than ServiceNow. I think, those comments actually are being latched onto as well. So IT index has seen another 1.5% gain after yesterday's percent rally. Remember, yesterday around these levels is when we saw some kind of resistance and some profit taking, closer to around the 31,000 odd mark. Let's see if today we can build on from there. Stocks in focus, home first because of the large trade. Stock is down close to around 5.5%. D-Development, a stock that's been running big time. That's come in for some cooling off today. So, that's a stock in focus. Volumes are quite large. Manappuram Finance actually started off well in the red, and that's pulled back from the lows. So a bit of a fight back is what we're seeing on that particular name. I'm talking about stocks that are moving on decent volumes. J&K Bank is another name that's actually moving with decent volumes, and that's up and about in today's trading session. Sanofi Consumer, stocks up 7.5%. Good move is what we're seeing out there. Tejas Networks, they're getting more business. Finally, actually, one would say, that stock, after coming off close to around a third from its peak, it's up close to around 7%. KSB as well reacting positively to its numbers, up 6.5%. And Le Travenues Tech finally seeing some kind of relief. The stock is up close to around 5%. Week to date, it's still down close to 7%, even after the 6% pullback. But net, it's a positive start to trade. 50 runs on the Nifty. Nifty is doing quite well. Nifty Bank 120 points. But the one that's leading today is the tech index. A relief rally, can it build on?
A relief rally, can it build on? There's a question. We'll be watching out for, whether there is any sort of, large trade that takes place in Eternal or not today, largely because of the kind of volume action that it is seeing. It opened sharply in the red and now has recovered a fair bit from the lows. In fact, it's now spiking at the high point of trade for Eternal so far. It's a recovery of nearly 3% from the lows. So that's one of the stocks. Maruti is the other one which is picking pace. SBI Card from the broader markets is slightly lower. Patanjali is the other one, which was one of the picks that our tech guests did give. And then we are seeing some traction, further sell-off on Home First Finance post the last trade as well, which extends its cuts to about 6% right now. And SpiceJet, after a big gash yesterday, seems to be picking pace once again right now. A lower price, at 15 rupees, it's up around 7% pop. That is what we're seeing on SpiceJet. Bandhan Bank is the other one which is doing well. And this morning we have IEX as well, which is higher by about 2%. All in all, a decent start for the market, even for the broader markets, where the mid-cap index at a level is up 0.4%. Number of stocks which are advancing, far outnumbering the stocks which are declining at around 1,600 is to 762 on the Bombay Stock Exchange. On the Nifty, in fact on the NSE, the number of stocks which are declining are sub 600. Perfect time to welcome our market master of the day, Karthik Kumar, who's the fund manager at Axis Mutual Fund, joins in. Karthik, the big question is on IT. What have you made of the kind of decline that has been seen, the news flow, the conversations around it, the likely impact, and how much of that is in the price? And is there something that looks, worth at least following at current levels rather than a buy or a sell action?
Thanks for having me. Firstly, with regards to IT, we continue to be underweight as it stands, as we stand right now. While there has been a lot of volatility and a lot of news flow, as you said, around terminal growth, terminal valuations, and so on and so forth. But even if you look at it in the near term, the growth prospects over this year or the next couple of financial years look quite mediocre, and there are other opportunities there within the markets that one can take advantage of. So given that context, we still remain underweight. Yes, valuations have gotten better. One of the positive outcomes of painful underperformance over the last few weeks. But I think we need near-term triggers for the stock, for the sector to kind of go up. In the near term, I believe the stock underperformance, we would not see a continuation of stock underperformance. But for the sector to recover, I think we need near-term triggers.
All right, we do need near-term triggers. Just as we were speaking about Eternal, the large trade has actually taken place. Nearly 10 crore shares or 1% equity has changed hands via a block deal. We'll get participants of that later in the day. But, the stock has seen a recovery. So maybe up until now, the pressure was largely on account of the supply that was expected on that block trail. And the stock has from there recovered about 2.5–3% at the higher point of today's trading session so far. Karthik, on a lot of these platform companies, you think that there could be an impact because of artificial intelligence and some of the tools that these guys are coming out with, that there could be some of these companies where a lot of their moats get compromised, and as a result of which there is not enough business case for them?
I think I would think that's an extreme interpretation of it. Surely we need to evaluate what is the impact of AI on these things, and what is the extent and what is the timeline that it could impact it in. So I think these are moving targets, and these have to be evaluated on an ongoing basis. But as it stands today, I think while we need to be aware about it and vigilant about it, but I don't think we need to go to that extreme conclusion with regards to platform companies.
Karthik, hi, morning. You want to first quickly tell us your view on the Indian markets as we begin 2026? 2 months done already, but we've gone through the earnings, we've gone through the budget. What lies ahead for the Indian markets? Because the performance has been so sluggish, and there is one view that what next, right? Many of the RBI actions are done, the GST rationalization is done. Earnings growth expected, but it seems to be priced in because we've been talking about an improvement, and Q3 showed green shoots that maybe it's on track, that a mid-teens kind of or 15–16% kind of earnings growth will happen. And generally markets price it in as soon as there is a whiff of it. So what will get us out of this funk?
Firstly, the sluggish start to the year is in line with our historical pattern, because typically Jan and Feb have been the weakest months for our markets. If you look back historically over the last 25 years, Jan and Feb have been the weakest months for our markets. So that is in line with historical trends. The good thing about the last 2 months is while we started out with FIs aggressively kind of taking money from the markets, that pace has gone down substantially. In fact, it has turned on the margins post the 2 FTA deals. So that's something positive. The other positive side effect is of the underperformance that we've seen to painful underperformance that we've seen to emerging markets is that the valuations have gotten better. So now essentially the focus then shifts to, in my view, earnings, the earnings growth over the next few quarters, and the visibility and clarity of earnings. I think that is what will dictate how our markets kind of move on from here. From a style perspective, what we saw in January was there was a momentum unwind in US that kind of spread to Asia and India as well, where momentum underperformed. And quality and growth also kind of underperformed over the last couple of months, leaving value as the standout outperformer, as we can see from the outperformance of PSU companies across sectors. So value has done quite well. But given the importance of earnings, I believe going forward, it'll be a more GARP-like approach that could do much better, where growth becomes paramount. And in that context, I think it's a much more distributed approach that will work rather than concentrated approaches like value or so on and so forth. So that is where I think the market is more likely to head towards.
All right. Hi, Karthik. Good to see you, Ben. A couple of fancied sectors which have corrected big time are railways and defense. We heard what the finance minister had to say in the recently concluded budget. And most of the spends were pretty much in line with what the street was working with. Now, these stocks have come off a goodish deal. What's your view on these names? Have they come to that region where you want to get into them, defense as well as railways? They had a big run, then they cooled off big time. So are they looking relatively more attractive?
I would say defense, some selective names on the defense side look attractive. Okay. From a purely quantitative framework perspective, railway names still don't show up. But from a defense standpoint, I think there are a few names that begin to look attractive at these levels.
Can you tell us which ones with the disclosure? How do we identify the ones which look good? Is it valuations being less than long-term averages? What is it?
I think it's both combination of valuation being lesser than recent measures, and also growth certainty in terms of growth certainty over FY 27-28. Both those things kind of tilt the case in their favor given the correction, and that is at a specific stock level, stock on a stock level basis within that sector. Yes.
This auto, it's been yesterday the Vahan data came out, the retail sales, and across the board, it looks like it's going to be a 20% kind of growth in the month of February, which means this is the third consecutive month post the GST rationalization. The demand is held up strong. What are your channel checks suggesting in terms of auto demand till the end of the year? And can there be a case of EPS upgrades for stocks?
So we continue to remain bullish on autos, and in fact, autos across the space, both two-wheelers and four-wheelers. Completely agree with you that the data has been quite supportive, and we see the data to be continue to be supportive for at least the next couple of quarters, and then we'll have to kind of wait and watch and see basically how it evolves. But I think the near-term data, both on the retail side, manufacturer side, both seem quite positive, and so we'll watch it through the year. But I think the next couple of quarters look supportive for that space.
Were there any investment decisions that you were holding out ahead of the uncertainty on the US-India trade deal, and now that there is some clarity, notwithstanding the sort of daily headline exchange that takes place, but you know that it's not 50% now, it's either 18%, 15%, or at best 10%. What do you make of some of the chemical names which had been underperforming because of this uncertainty, some of the textile names? Are there opportunities there, and maybe some auto ancillaries as well?
So I kind of look at quantitative strategies, and from a quantitative strategies, what matters is data certainty, whether you look at it from a forward-looking basis or a historic basis. So so that uncertainty with regards to tariffs and policies and the FTA meant that I didn't have much exposure to some of the sectors that you've mentioned, and that still continues to be the space. That still continues to be the case. Sorry. So I'll continue to monitor the data in terms of how they evolve and how they kind of feed into the larger process, and then take a decision when things improve materially. But as it stands right now, we still continue to, at least on the purely from a quantitative framework perspective, we still continue to remain a bit light on the sectors that you mentioned.
All right, Karthik, we talk a lot about equities, but the asset class that's really made big money has been gold. Even those on a global framework, even those dips that you're seeing actually are getting bought into. And gold, after correcting, I think it pulled back close to 10-15%, and it's back closer to the peak. What's your view on gold? And, as a percentage of your portfolio, do you think it requires a higher allocation? And if yes, what will it replace? The safer bonds, or, will it replace the equity?
So, I think gold has a longer-term structural story in terms of dollar weakening and looking for alternate and global central banks across looking for options aside from that. So there is a longer-term story which I think is driving that. So, and we also believe that investors should have allocation to gold and silver, so still continue to stand by that. So we remain constructive on both those asset classes going forward. With regards to what should be the allocation, that is on that I think is more on a case-to-case basis. But I think there are no two thoughts about it. One should have allocation, and whether you have it through multi-asset funds or whether somebody does it proactively at a portfolio level, I think that is a decision on a client-by-client basis.
Right. So when you said that you look at quantitative data and quantitative strategies, fair to assume that you look at it on the short side as well, or is it just a long only?
So it's mostly on the long only. All these are mutual fund strategies, so we are looking at long only strategies as it stands right now.
Is there anything that has swum into your ken very recently because of the movements that we've seen already, and that's looking a lot more attractive?
We continue to remain bullish on power, T&D names, autos, financials. pretty much broad array of financials. Those are large overweights, and the underweights remain staples, IT, utility names, and some of the commodity stocks in the commodity space. Those remain the underweights.
Okay, thank you very much, Karthik, for joining in. That's the view coming in from Axis Mutual Fund. They've got a bit of a domestic bias over export-oriented stocks like IT, and IT is still underweight even after the correction. Though today, IT is doing well, even mid-cap IT. So it's a broad-based recovery. Birla Soft 2.5, eClerx 2, Hexaware 1.5, Persistent 1.3, Oracle Finance 1, Tata Elxsi is up 1. The Nifty IT index also is up close to about 0.8%, but still this month it's down close to about 19%. So the gashes are deep, but for the last 2 days it's attempted a bit of a recovery. Shriram Finance is now your top Nifty gainer. You've got life insurance companies in the fray on the way up, SBI Life, HDFC Life. Eicher Motors is up 0.8%. At a broader level, we should pull up the Nifty Metal Index, and the other one is the Auto Index. These were the two pillars of the market outperformance yesterday. The Nifty Metal Index is flat, so no follow-on rally there, but it's had 2 good days on the trot, and autos too, not doing too much.
All right, well, let's get to our next management. Mr. Rajiv Mantri, the Chief Financial Officer at Bandhan Bank, joins us on the show right now. Hi, Rajiv. Good to see you in. And I'll tell you what, in this year itself, the stock price is telling you that the street believes maybe the best is yet to come and maybe the worst is behind. At least just going by the stock price. If you could argue in the last few years, well, it's still a far cry away from those levels that we saw. That said, we want to understand a couple of aspects. So let me just state out a few points that we're looking at. Progress on the NIMS expansion. Is there a recovery underway in the MFI segment? And the path towards a sustainable ROA of around 1%. Well, Rajiv, let's start off with point number 2 then. Let's talk about, the MFI book. I think that's a third of your total book right now. And the feedback you're getting is things are actually improving on ground. So could you tell us what are you observing? And also, you've been talking about increasing your secured book. As a percentage of the mix, what is the proportion you'll want in to come from the secured book? Please go ahead.
So good morning to you and good morning to all the viewers. I think definitely we are seeing a recovery coming through in the microfinance segment. The cycle has been fairly long, lasting almost about a year, last 1 year. And the main reason for this cycle turning adverse was because of the whole over-leveraging situation that happened in the market. But what we had sort of guided the market beginning of this financial year was that we will see sequential improvement in the portfolio quality. And then by Q3, we should expect a more profound recovery to come through. And that's exactly what we have seen. The slippages that we actually saw for the bank between Q2 and Q3 improved by almost 280 crores, of which the microfinance improvement was around 200 crores. So I think that is something which gives us confidence in terms of how the portfolio quality improvements are happening. What we also see is when we look at the forward flow rates, from the various DPD buckets, towards the NP as well. We are definitely seeing improvement on that front as well, right? So just to give you some stats, the sort of forward flow in terms of the collection efficiency, which is X buckets, which was almost about 99.5% in Q3. In the latest sort of quarter, early trend suggests it's gone up by almost 20 basis points to 99.7. And I think that is giving a good confidence in terms of how the improvement is happening.
Okay.
We do expect this to continue in terms of an improvement on the portfolio quality, albeit on a gradual basis over the next few quarters as well.
Got it.
And I think the second aspect on microfinance is really about the growth. I mean, as you know, because the industry was going through a cycle, we clearly saw that the overall industry actually has shrunk by close to about 16% in terms of the advances. Within that context, this is from December 24 to December 25. And within that context, from a Bandhan Bank standpoint, we saw actually our book degrow by roughly around 10.9 or 11%. We also did a significant ARC sale in the quarter of December, which was around 3,200 crores of NPA, of which about 2,800 crores was relating to the microfinance portfolio, which we call as the Emerging Entrepreneur Business or EEB. And if we normalize for that, we actually saw that the degrowth year on year was only about 5.9% or around 6%.
Okay.
In fact, sequentially, if we normalize for the ARC sale, we saw a growth of about 1,100 crores.
Right.
So this is also giving a confidence that we are seeing disbursements go up. We are continuing to hold our guardrails that we had implemented, be it the 3 loan criterion, be it the cooling period concept, or various other guardrails that we had put in place.
Rajiv, sorry to come in. So we get the point. MFI is on the mend and things are looking up on that portfolio. The secured book, that as well has moved up on a very small base as a percentage of your book. How much can it occupy? Very quickly.
Yeah, so I think secured book, the momentum is on. We had seen about a 27% growth on a year-on-year basis. So that is being driven by housing portfolio, retail assets, which is the secured retail assets, as well as the wholesale banking portfolio. So I think the growth in that has been quite encouraging, about 27% growth there. We had, as part of our strategy, set up that by FY27 end, we will increase our secured mix to about 58%. We started our journey at about 42% in March 24. Very happy to say that we have already reached about 57% by the end of December 25. So we're running a little advance on that. Of course, we will continue to pivot towards a higher secured share. But the pace of change of secured mix now can be a little less steeper as what we've seen in the past.
So when we speak about the secured book increasing, etc., there are multiple impacts of that as well. On the one, yields go lower. That could have a problem on the NIMs. NIMs may compress, but at the same time, your credit cost reduces, and you have set out targets for all of them as well. For credit cost, for one, it's 1.6 to 1.7% by the end of FY27. Which implies a near 40 basis points reduction every quarter. Are you on track for that? That's point number one. Secondly, a comment on your NIMs and yields as secured book increases. And as a result of all of this, your ROA target of 1%, what are the drivers for that?
Yeah, sure. So I think if you look at the credit cost, a year ago, we were almost about 4.1%. We had steadily reduced that, I think, by the Q3 of this year. We brought it down to about 3.3%. So the trajectory of improvement in the credit cost is very much on. Here on, we expect the credit cost to sequentially continue to improve. And yes, the guidance that we had given is by the exit of FY27, we expect that to reach around 1.6 to 1.7%. I think the broad logic of that is a third of the book, which should be in EEB or microfinance, at about 3% credit cost, sort of steady state credit cost of 3%. And the 2/3 of the book, which is largely secured, should be around 1%. So with a weighted average of about 1.6 to 1.7%. So that's the aim, and we are clearly steadily making progress in that regard. On the net interest margins, I think we had said that Q2 is what we believe would have been the bottom, and we got severely impacted by the repo rate reduction, which we could not transmit to the depositors. We could only transmit to the savings account holders, but not to term deposit holders, as our deposits are locked in for a longer period of maturity. However, we had seen an improvement in Q3. The NIMs went up from 5.8% in Q2 to 5.9% in Q3. And we are confident over these 3 quarters, which is Q4, Q1, and Q2, about a 30 to 40 basis points improvement in the NIMs is what we can expect. This is largely driven by the repricing of the term deposits that come in for maturities in these 3 quarters. And we had seen that the rates have really come off compared to the last year, where we stand right now. So we are fairly confident towards that. Your last question on the return on assets, we definitely have, seen a sequential improvement. Of course, Q2 was a low quarter for us, which was around 0.2%. It went up to 0.4% in this quarter. Our guidance is by the exit of FY27, we are aiming to reach around 1.6 to 1.7%. Give or take 10 basis points. The reason for that and the way in which we'll be able to achieve it is we expect the NIM trajectory to improve further. Apart from that, there is a lot of effort that the bank is putting in place in terms of driving the other income growth. We already have seen a good momentum in our third-party product sales. As the microfinance disbursements improve, we should be able to see an improvement coming through. Sorry, just give me a second. We should be able to see an improvement in the disbursement-linked processing fees. And also, we are looking at introducing newer capabilities in our wholesale banking portfolio, which is around FX, trade, as well as transaction banking, which should be able to generate some new lines of revenue.
Just to confirm that number, you said ROA will be 1.6 to 1.7% by exit FY27. That's correct, right?
Right. So I think for the full
That's
year,
from
it may be
0.4%
lower.
right now.
For the full year, it may be lower because we're starting from a lower trajectory of 0.4% now to reach to that level. But yeah, that's our aim to reach by the end of FY27.
Okay, just one word answer because we're out of time. Rajiv, so FY26 loan growth, 11 to 12% is what you told us last time. That holds. And how much can you scale FY27 loan growth to?
So I think the overall loan growth CAGR that we have been looking at for the next 2 to 3 years was around 15 to 17%. We are still aiming for that. The breakup of that is really the secured book to grow faster, around 20% plus. And the unsecured, which is largely the microfinance, to grow between a 5 to 10% positive territory. The challenge we've seen is around micro because the last 1 year, the book has degrown as opposed to increase. What we are working towards is from a negative 10% on the microfinance year-on-year growth rate right now to take to a positive 5 to 10% growth. On the secured book growth, I think we are fairly confident and the momentum is pretty much on. So that's what we're aiming at, around a 15 to 17% CAGR over the next 2 to 3 years. And we hope to try and meet that by the end of FY27 as well.
Rajiv, very quickly, you believe the worst is behind for the bank? In the past, we have seen ROAs even in excess of 3%. I recall, I think that period between, 2017 to 2020, maybe a timeline will be a little off, but I recall there were very, very great days out there. So shareholders will be wanting to know, do you believe the best is ahead and the worst is behind? Would that be fair?
Absolutely. I think I would be confident to say that because what we're trying to do is a structural change in the bank towards a balance sheet which is more resilient. And what we're trying to do is improve the secured mix, which provides more consistent set of returns. At the same time, we want to retain our leadership position in the microfinance segment, which allows us to be able to provide a little higher returns on the assets. So I think it's a more stable balance sheet, more consistent set of returns that we're trying to work towards.
So is a fundraise on the cards?
Well, at the moment, our capital ratios are fairly comfortable. We have 17% tier 1 and 17.8% overall CRAR. It allows us to be able to grow at least for the next 1 to 2 years, given the advanced growth that I just mentioned, and given it's still pivoting towards a higher secure mix.
But is there a fundraise on the cards? Have investors reached out to you? Since things are on the mend, ROA is looking up, credit costs coming down, growth coming back as well, and the worst in terms of the MFI sector behind.
Yeah, so I think we have been discussing with the investors. We've been doing the outreach. We've been attending some conferences as well. And we've been explaining, I think, the similar points as I just mentioned earlier to the various investors as well.
All of last year, a lot of the foreign institutions were looking to buy Indian banks, Indian NBFCs, etc. Have you had any conversations around that as well with any sort of global bank, global investors on a strategic basis rather than just financial?
No such conversation at the moment. We have really a good support coming from all of our investors. We have 40% stake held by the promoter, which is our Bandhan Financial Holdings company. So at this stage, there is no such conversation that's happening.
Thank you, Ramesh, for joining in. Always a pleasure chatting with you. And thank you for this candid chat. We will slip into a break. On the other side, Barclays Private Bank's Julian Lafarge joins in to talk about markets and more. Stay tuned for that conversation.
Welcome back. The market's holding up well. Infosys has moved to the high point of trade. Alongside that, we do have some traction coming in on names like IndusInd Bank, etc. as well. The Nifty closing in on that 2550 mark. The broader markets have one shade better, 0.2% in terms of gains for the mid-cap index. Nearly 2,000 stocks which are in the green right now. But conversations around AI continue as investors on Wall Street and around the world assess the AI disruption and its impact. NVIDIA CEO Jensen Huang did say that markets have miscalculated the AI threat to software companies. In fact, in an interview to CNBC, hours after the chip behemoth issued an upbeat sales forecast on strong AI demand, he spoke about this. And let's actually hear that out, and thereafter we'll continue this discussion in our studio.
I think the market's got it wrong. I think it's very likely that these companies that we're talking about are going to introduce agents that run on their platforms. You know, these agents, of course, they have to be experts in what they do, and nobody's going to understand customer service better than ServiceNow, and they're going to come up with agents that are really fine-tuned and optimized for the type of work that uses the tools that they have. In the end, also, we need the tools to finish their work and put the information back in a way that we can understand. And that we call them system of records. And so each one of these tools have their own system of records. Those system of records exist because we put them there and we use it so that we understand the information that's finally complete. And so those system of records will still be ground truth, and they'll continue to be ground truth. And now the agents will, help. They will use it, and they will populate the system of records. They will use the tools that are available on these platforms.
Markets got it all wrong about the role that software companies will have to play in this agentic AI world. Previously, he had said it's illogical to expect that they would be replaced. But we've got someone, an expert joining in the studio who can talk about the AI euphoria, now the moderation that we're seeing, where markets are headed, global emerging markets. Julien Lafargue, Chief Market Strategist, Barclays Private Bank, joining in. Julien, thank you very much for joining in. I was just reading a recent report of yours, 2026, The Interpretation Game. Interesting title. Can you take us through the broad thesis?
Sure. Well, I guess the broad thesis is that in 2026, investor will have to look at every single data point, trying to interpret one thing and one thing only, really. Are we seeing productivity gain related to AI? Because if you think about it, those productivity gain underpin everything. They underpin the AI trade. If there is no productivity gain, there is no demand for NVIDIA chips and there is no demand for AI. And it's also very important when it comes to another issue that we haven't discussed in a long time, it feels, but sovereign debt. Because the only way to get out of this debt spiral around sovereign debt is really through productivity gains, through higher growth. That's how we're going to reduce the debt burden. So for us, the only thing that matters in 2026 is productivity gain. The problem is you cannot observe productivity, so you have to interpret each data point with this lens of are we seeing productivity gains or not.
So what are those data points that you would be looking at to absorb productivity gains? Because like you said, it's not visible. No one comes up at the end of the month with the report that, okay, this was the productivity gain.
No, exactly. I mean, you do get some productivity figure when you get US GDP numbers, but that comes with a lag and on a quarterly basis. So I think it's going to be signals like we see in the earnings report, company finally talking about actual productivity gain. Now, I'm sure you interview a lot of CEOs and CFOs, and all they say is, yeah, we're seeing the potential gains that AI can bring. Nobody has really been able to quantify that. Exactly. And so we hope to see in 2026, probably Q2, Q3, some CEOs, some CFO coming with tangible numbers, like these are the productivity gains that we've been able to achieve. So that I think is the key data to focus on.
Hi, Julien, good to see you in. Now, do you think that these productivity gains in turn will impact economies, impact consumption, discretionary spends as well? Where are you on that argument?
Well, so I think that you hear a lot of people saying, oh, look, since ChatGPT came out, if you look at US productivity, it's gone up a lot. But we would challenge that view because what you're seeing is just productivity gains that are similar to any productivity gains we've seen post any recession in the US. What happens when you have a recession, in this case, the pandemic, you have a reallocation of labor. So people change job, they become entrepreneurs or whatever, and that leads to an increase in productivity gain. So we think we haven't seen any real productivity gain linked to AI just yet. We think is going to come through, hopefully this year. I mean, it has to come out this year, otherwise we're going to be maybe in trouble.
So otherwise that trade will unravel. But be that as it may, you have the outside-in perspective to markets like India as well. What are your thoughts on that? Because barring February, for the last 6 or 7 months prior to that, we've constantly seen money going out of India.
Yeah.
What's causing that?
Well, I think India had been a very popular trade among international investors for a long period of time. Most recently, I think India is less in focus. I don't think people are necessarily worried about India. I think it's just that they feel that there are better opportunities elsewhere when allocating global capital. Because there are a couple of things that are lacking in India when you look at the stock market. One is, of course, the AI exposure. And second, it's sad to say, I'm sure, and I'm really happy to be here in India today, I'm sure it's not the case anymore, but a lot of people still see India as this software-led type of economy, service-led type of economy, which could be challenged, in fact, by AI. So I don't think people are necessarily worried about that too much, but I think, they look at China, they look at Japan, and those are, at the moment, more exciting stories for global asset allocators.
Julian, you're advising the richest people in the world, and they want to get richer, right? What's the advice that you're giving for 2026? Top down, globally, like all asset classes included. Well, where can maximum money be made this year?
Well, I think the key this year, that's going to sound a bit boring, but it's really about diversification. Because, I don't think anyone has been able to capture the change and the shift in narrative we've seen just since the beginning of the year. We're 2 months in and we've seen everything happen already. So you really need to be diversified. And what you need to be is also to be focused on, I think the diversification should also be geographical, right? It's not just about one sector versus the other. I think a lot of people have been overexposed to the US market, and that was the right call for many years. We think this is changing. You want to have exposure to other regions, in particular emerging markets.
Okay, all right.
Do you want to break up? Sorry, just one follow-up. Do you want to break up how you will diversify $100?
So, well, look, for us, equities remain the engine of growth. So if your goal is to become richer, you definitely want to have exposure to equities. There's no fixed income that's going to allow you to do that. We also see some benefit in being exposed to more alternative strategies, I would say. Strategies that are not necessarily betting on the market going up or down, but that are playing the dispersion. Because if there is one thing that we observed this year is very elevated level of dispersion among sectors, among stocks. So we would focus on that.
You just said $100 for a person who...
That's why I didn't answer the question, because $100 is not enough.
To be very honest, she'll come to you with $1 billion shortly. But Nigel, go ahead.
Yeah, all right. No, I just wanted to understand, with regard to the US markets, the point that you made, that mother market has done very, very well. That's good actually for global equities. Yes, the Indian markets have underperformed. But do you think the US markets are getting to a stage where it's, could go through a phase of consolidation after the recent run? That's point number one. And point number two, I wanted to understand with regard to Trump's tariffs. Peak Trump seen or peak Trump to be witnessed?
Okay, so on the US side, I would say, I think consolidation is the right term, more so than, a significant pullback or anything like that. I think you still want to have exposure to the US. That's still the main economy. That's still the main market. So, but yeah, people are going to be looking at other regions, and I think that's going to weigh on the momentum in the US. When it comes to tariff, look, I think the peak was reached on Liberation Day. And since then, it's been just a walking back of a lot of the announcements that were made that day. And I think this is going to continue going into the midterm election. So, for example, we had this announcement that it would be 10% across the board tariff. The next day was 15, but in the reality so far it's only been 10, and the 15 is not sure. So I think this is the direction of travel.
And just to finish the point with regard to the US, how many Fed rate cuts to be this year? We're going to have a change at the helm. Some thought it's going to be 2 or 3, and then some are saying that we may not get any. Which camp are you in?
Well, we're probably in the more of the 2 camp, but the reality is, is it 2 or 3? I don't think it matters for a lot of people, to be totally transparent. I think what matters is that interest rates are coming down, and I think investors need to think about that in their allocation in particular.
I just thought I'll ask you that because from an India market perspective, the dollar index is important since the emerging markets track that very, very closely. But it's good to have you in the studio. Thanks a lot for coming down, and we look forward to more such visits. And Rima's keeping the 100 billion ready.
Billion ready, at least for now. But, for those who are not having billions, what about gold? I mean, is there a view that you have there?
Yeah, so for us, look, it's a key part of any well-diversified portfolio. I think you don't want to own gold for speculative reason. You want to own gold because it plays a key role in portfolio, that until very recently, bonds, in particular treasuries, haven't been able to play. So for us, is this anchor in portfolios. We continue to have some exposure. We reduced a bit the exposure when we felt that things were getting a bit too hot. but we maintain a decent amount of gold in our portfolio.
Those who are very rich also get fairly adventurous with crypto. You have a view there?
Yeah, sure. So for us, again, we look at a portfolio. This is a new asset class. Can we use it to make our portfolios more efficient? And the reality is, at this point of time, we cannot. We cannot make it work in a traditional portfolio sense. It doesn't mean you cannot have access to it and you shouldn't have access to it. But when we design portfolio, it doesn't fit there because volatility is too high, because the correlation is unclear. Sometimes it's correlated with the NASDAQ, sometimes it's not. So for us, is more something that we would do on the side rather than a part of a core portfolio.
Julian, always a pleasure. Thank you very much for joining in. Hope you enjoy your India visit and make a trip once again back home. You know, so in India and tech stocks, interpretation game is all about interpreting whether AI is going to help software companies or it's going to hurt. And that's been the raging debate when it comes to India for the last so many weeks and months now. So this gives us the perfect segue to invite Ramesh Lakshminarayan, Group Head IT Chief Information Officer at HDFC Bank. Ramesh, thank you very much for joining in today. I think this is our first conversation, live markets. We have so many of these Indian IT companies, and they've been battered out of shape because of two concerns. One, fears of revenue deflation, and two, perhaps enterprises like you will move to AI agents and therefore reduce the work or the spend of Indian IT companies. Now, you are in an enterprise, you work with Indian IT companies. If you could tell us the extent of deflation that you've seen. So when your contracts come up for renewal, how much are you pricing it down? And is there a thought to reduce the services spend and maybe experiment with these foundation AI models? Oh, I think you're on mute.
Thanks, Rima, for having me here. Can you hear me? Am I audible?
Yeah, we can.
Yeah, no, thanks, Rima, for having me here. First time on this show. Glad to be here. I think it's still very early days, to my mind, in terms of putting the impact together. Look, this space is changing very fast. I think every week we are seeing some announcements. Every day, in fact, there is something new coming up, and enterprises don't necessarily react in that way. So you need to kind of give it a little bit time. We will calibrate. As of now, like I said, we are very focused on what we are building and how we are looking at the entire AI space. And while we're kind of dealing with our partners, we're looking at saying how do we really, navigate to the new age solution. I mean, today, for example, do you really need to build a SaaS application? And if you really don't want to build it, what is the alternative? If agentic AI has to come in there, how can the partners help it? That is the conversation that I'm right now kind of seeing. Early days, I think I don't necessarily see the recalibration happening in a very, a deflation rather happening in a very big way. I think there will be recalibration to my mind. The models will change very, very fast, and we will see how this goes.
So if you could, quantify that sort of recalibration, because just before we were having this conversation with Julian, who was speaking about the key monitorable here being productivity gains, right? So if you could give us a sense on how this will work for you in terms of either one, reducing response time, increasing service quality, improving as a result of which the sort of revenue or conversion rates, those metrics that you monitor, and on the other part would be reduction of costs. So on both those parameters, have you set yourself any target or have you seen any initial trends and any potential that you can quantify here?
I think it's, again, like I said, the way to look at it is not look at isolated use cases and say, hey, I will get a certain percentage. The way we have looked at is, can you go back to the foundational processes? See, just overlaying an AI on top of an existing process is not going to make sense. And the reason I'm saying is, take a simple example like acquisition journeys. In the old world, you will have the UIs, the click-throughs, certain number of screens to go through. In the new world, maybe it will just be a AI, a window on top of it. And that doesn't mean the process behind it kind of changes in the sense that, you will probably have some extraction engine pulling a document. You will have a scoring model that's running in parallel. Now, can that, for example, reduce the first time right? That's one of the big KPIs that we track. In fact, that's one of the initial KPIs that we're trying to move towards, saying when we get something like that, can we get the documentation right for the customer when he comes in? Second, is the turnaround time. I mean, clearly, the number of hops that you go through especially in some sectors where the acquisition is still not fully digital. I mean, for example, in SME sector, you might.
Oops, we'll try and
multiple kind of iterations before you kind of approve. That is the other part that we are kind of looking at very carefully. Then, of course, we do have the third part, which you said, our own productivity. I think there we are seeing gains, especially in the back-end coding side. Coding is a capability. See, the way we see this whole landscape play out, you need to look at what capabilities AI will drive. For example, bank has extraction, core extraction as a capability, search as a capability, voice to text, text to speech as a capability, coding for our own development as a capability. So when you're building this foundational layer, can you get your first time right? Can you reduce your turnaround by X? Can you kind of, obviously reduce the cost? The way we are seeing all the three playouts are happening depending on the use case. And one of the principles that we have used here is to build a centralized platform here. Unlike, many of the market movers, we've not gone to a third-party partner. Actually, we built our own platform because our idea is to have a centralized AI platform that's able to enable all these use cases, and thereby the measurement of the KPI or the measurement of the benefits is real and it's on the go, actually. So that is the approach we are taking. So it's kind of right now early calibration. We are seeing definitely benefits, especially in turnaround times. I would say that's the first part. And second is definitely reallocation of the resources to the front end in some of the key projects. So these are two areas that we are definitely seeing some benefits.
Okay, hi sir, good morning, good to see you. Well, if I take a reference point, global banks like JP Morgan, they spend a large amount of money on tech, on AI, cybersecurity, and other initiatives as well. As a percentage of revenue, it's ballpark around 10%. But as a percentage of expenditure, it'll be closer to around 20%. Would you all look to increase your digital spend?
So I think we are again pretty much on global benchmark standards. It's similar ranges that we spend in if you go and look at it. And see, technology continues to be an area of investment. I mean, those days are gone when technology will be a support function in a bank. In fact, HDFC has a very different thought process in the way that we are pivoted from a partner-driven technology development. While we do work with a lot of partners, but certain areas we have very strategically pivoted to a factory approach, where we are building a lot of our digital products. So we've got factories in Bangalore, 2 factories in Mumbai, 1 in Gurgaon, and then we just opened 3 days back in Guwahati. Why are we doing this? Because just like some of the global banks, if we don't convert ourselves into a technology development first kind of a company, we're not setting ourselves for future. So obviously the spends are going in that region. So the nature of the spends is changing. It's no longer about looking at maintenance BU, while they're very critical, resilience, and all of that area is boxed in, and those costs continue to kind of go at the same level, just to ensure that there are no hiccups. But the spends are moving into areas where you can kind of see the business benefits quite quickly, especially in the area of AI-driven development.
Okay, just one final question. We can keep it short. As the nature of spends is changing, the fear is that it's crowding out the spends that would have otherwise gone to IT services companies and vendors of yours. Now, you yourself have taken so many internal projects. You're doing it yourself. In that sense, what is happening? Is it negative for Indian IT companies?
I think they will have to relook at the model, Reema. I think that's the fundamental take that I have, because just the T&M model or the application development through people, those days are gone actually. So really the value that they bring to the table. So let me give an example. I mean, for example, if somebody comes to AI solution, for example, in detecting a fraud opportunity, I think that is something that we would kind of take a look at it. Hey, tell me how is your fraud model more effective, and is it kind of market benchmark to detect better fraud controls? That would be the conversation, and not saying, oh, I will need this many number of people to do a project or this many resources to a project. So the entire conversation is changing to value adds actually, and not basis resources, and that's going to be a significant shift for the IT services company. And I think they are calibrating as we speak. Some of them will calibrate faster, And those are the ones that probably will come out winners in this race. The way I see this, as they start getting ready for this AI rush.
Thank you, Ramesh, for joining in with your insights. Great conversation. Out of time, need to slip into a break. On the other side, Shilpa Rao to Prabhudas Leeladhar will join in for some technical trades.
Welcome back. Well, the markets are building on to the gains. The Nifty is up close to around 85 points and the breadth of the market pretty good. Good time to get in Shilpa Rao, Senior Analyst Derivative at Prabhudas Leeladhar. Hi Shilpa, good to have you on the show. Give us your call on the Nifty. Do you think we're in for a bigger run? We're already 85 points higher, so the fresh trade on the Nifty and a couple of trading calls. Please go ahead.
Good morning, Nigel, and thank you for having me on the show. Talking about Nifty, we have a good support at around 25,450 to 500 band. That is where we are timely again and again testing and seeing some sort of a bounce. So we should go long, and the resistance is placed around 25,700 zone. So we still have a room on the upside to play. And for Bank Nifty, the support comes at around 60,800. So again, you can go long here. It can do 61,700 zones. So definitely still a long view on Nifty and Bank Nifty.
All right. And individual stocks, what are you backing?
I have two buys. The first one would be on BEL, Bharat Electronics. The stock is trading around 442 in futures. It is looking good. It has a support around 435. So one can go long here with a target of 455 to 460 zones. The other one would be from the pharma pack. Cipla is very well placed. Futures trading at around 1369. It has a good support around 1340 and keep targets around 1400 zones from here.
All right, Shilpa. Thanks a lot for stopping by and giving us your views on the index as well as individual stocks. We'll take your leave on that. And in fact, we'll wrap on the equity coverage of Bazaar so far. In fact, on the other side, the special segment, it's the economy. Lata speaks to Kamaksha Trivedi of Goldman Sachs on the rupee and the dollar index as well as rates. Stay tuned for that.